Vikas Khemani is ready. Let's connect with him and let's say hello to him to understand where he feels the market's headed for 2022-2023. Good morning. How have you been, my friend? Long time.
Good morning, Nikunj. Yes, long time. Happy New Year to you.
Same to you. So, what is it looking like for this year?
I think Nikunj, this year, we will have a little bit of a mixed kind of sentiment. There are headwinds for sure, which is coming both from a global market as well as the local economy. So, probably the way I see this year is you will have some of the global headwinds playing out, and which will have some implication on the domestic economy as well. So, first 3 to 6 months could be fairly uncertain and volatile period, and again, that will depend what kind of policymakers' response comes post that, and data dependent one would make a view. But the way at least I would like to characterize this year would be, some headwinds, some tailwinds. And the one thing in this kind of situation where the markets are fairly valued, market tends to be volatile. So the impact of steep Fed rate hike and quantitative tightening always happens with a lag, and the economic impact of that we will see in next 2, 3, 4 months time, beginning to see. So I think we have to keep all those factors in mind, and markets are in a fair valuation range. So you will see a reasonably range bound to volatile market, and which could probably do well in the second half of the year is how I would like to probably think about it, the market at this point in time.
Uh, we are not off to a great start for this year. Commodities have melted. Forget inflation, it's the recession fear which is now back. China has started stabilizing. If I look at the meltdown in big tech, that also is having an impact on the financial market per se. What to your mind are the chances that in this year, while India will grow, the fear of recession, which is a more dangerous fear than high inflation, could actually lead to a financial dislocation in next 2 or 3 quarters?
So, see, in my opinion, Nikunj, if financial dislocation happens for a few reasons. One is, I think leverage is always the, big reason. Whenever there's a tightening or sudden shock to the happens in the system, and there's a leverage, which kinds of leads to the big financial dislocation. Fortunately, this time around, despite such a sharp correction in the market, such a sharp, loss of the value of the assets across the board, fixed income, crypto, equities, we haven't seen any sort of repercussions or rippling effect across the board. Key reason for that is the banking system this time around is not leveraged. The balance sheets are very solid. So the pain is sitting somewhere else. Now that pain, where it is sitting in the complex world, one is very difficult to guess. My sense is that is more sitting right now in the balance sheets of the government and pension funds, and which are fairly sort of long dated. So, and one would never know the timing. One would know that how it will come, whether it at all it will come. So the good news is that leverage in the system at least is not right now there, but some point in time it has to play out in its own way. Whether it will be a slow play out or sharp play out, I don't think anybody knows. But my sense is that I would assign so far if the probability of that should not be very high, given the fact that it has not played out so far. Uh, how Fed sort of reacts to, and currently I guess next 3, 6 months, I don't think Fed is going to give any dovish outlook till the time they see a very strong conviction around the inflation. So I think next 3 to 6 months period would be uncertain. I wouldn't say a very big sharp fall or steep kind of situation is visible, but in markets we have seen, Nikunj, risk always come from unknown. One does not know, right? So when there's a tentative environment where one has to be a little bit careful about the risk, and I think that is what characterizes the market. And I feel next 3 to 6 months one has to be very watchful, see data and how things pan out.
So, for an investor, Vikas, what does that translate into? Where is it that you would be underweight? Would you immediately go in capital protection mode, keep some powder dry, continue to buy dips? It's a bit of a confusing scenario purely because there are so many factors at play.
Absolutely, I think so. Absolutely, and whenever this kind of scenario comes about, it is always, in my opinion, advisable to keep some dry powder. Now that whether that dry powder should be 10%, 15% is anybody's guess. It depends on anybody's individual strategies. Of course, some bit of a defensiveness should be built in the portfolios. There's no doubt in my mind, and that is what I think one would do, and one is doing. Having said that, we also know, and I must say that uh, right now this worry and anxiety is also in some sense pretty much consensus, right? So one has to be watchful of that. Everybody knows that recession is coming. There are problems, there are pains. So how much of that is already factored in, one does not know, right? So one has to be careful. But yeah, I personally feel that some amount of dry powder would be a good thing to have right now.
Hi, Vikas. Let's also discuss some of those underlying themes that you had spoken about in the past that can really be beneficiaries of the manufacturing and export growth that's going to play out. The specialty chemicals, auto components, textiles, defense. Can you just elaborate a little bit more on some of these themes?
Sure. So I think manufacturing continues to remain a very big theme. I think I mean, nothing changes from a 5, 10 year perspective. And we have seen whenever any big trend plays out over a long period of time, there will be intermittent volatility. There will be intermittent, downturns, which will come and be part of it. We see that as a big opportunity. If I were to go back, let's say IT, when it played out in mid 90s, it was never one way. We saw many drawdowns to the extent of 30, 40% in most of the large good tech names, right? So you will see similar kind of things happening in this. But the good thing is that this is a structural trend. It is not changing. It's not a tactical sort of opportunity. So we would see this, if any correction happens, more to deploy money or buy some of those good businesses rather than getting worried about it. Yeah.
Your top holdings, they include names like L&T, Loris, Syngene, Bharti. For me, what stands out is that if I look at the declared portfolio, out of the top 10 holdings, 2 are pharma names. This is a call which is completely against the street. Why?
So I mean, it's not a call against in some sense of pharma per se, but both businesses models are very, very different. If you see, Syngene is not a pharma company; it's a CDMO, CRO and CDMO company. It's a very solid company. In an environment like this, their business model is good. They have done a lot of sort of capex in last 2, 3 years, and we think that delta of that is going to come in this year or next 1, 1.5 years, and which is not at all dependent on anything what happens in the environment. Now, according to me, investing in a place like this at this point in time, provides a lot of risk reward comfort downside protection, right? Similar is the case for Loras. It has corrected 50, 60% from the top. Business model is good, opportunity is good, so we in fact just increased our stake in that. We had earlier position, but we increased our stake in that. So we feel that we have kind of done some sort of portfolio alignment, given we think, like you mentioned Bharti, we think that in an environment where globally things are uncertain, locally things can be uncertain. Telecom is the one sector where I think ARPUs are going. I don't think there can be any slowdown in the consumption of data or subscribers. Industry remains robust forever. So it is kind of completely immune to, in my opinion, it's one of the best consumer play you can have, where the industry is consolidated, only 2, 2.5 players market, rates going up, nothing changes because of the happening environment. So I think this kind of situation kind of tends to help, in markets like this, frankly speaking.
Okay. For me, a standout name, Vikas, is Aditya Birla Financials. I think we spoke about it about 6 weeks ago. It's done very well. Good, it was a good spot. I can see similarity in Aditya Birla Financial versus ICICI Bank. There was a time then when we spoke about how there's a change of guard at ICICI Bank and it could really reboot itself. And ICICI Bank has managed to reboot itself. Could the same happen to Aditya Birla Capital? Is it a fair idea to compare ICICI Bank management change with Aditya Birla Capital? Because that was a bank and this is an NBFC.
So again, both are very different size, scale, and franchises, no doubt about it. But both are incredible franchises. And the reason why we bought, I outlined to you, is that it's a good NBFC. There are no major problems. One of the biggest thing in NBFC is the liability side franchise, and they borrow capital at a similar cost to as Bajaj Finance, right? I think Vishaka coming in, according to me, adds lot more energy or drive to the whole platform. And we think that this is completely ignored stock by the market. The institutional holding is almost close to zero right now if you take out the two private equity which owns. So it's under owned. Big change is happening in that. Similar to in that sense setup what ICICI Bank was there, where it was under owned, change happening, and over next 2, 3 years, I think it can deliver 20, 25% kind of growth. So we can be patiently, and valuations are clearly in your favor. So I mean, this is the kind of setup we call in our Carnelian language magic basket stocks, where you can get both earnings growth as well as the valuation re-rating, and that is where. So let's say If the current valuation, when we bought around $100, what book value was one time book. If it goes to two time book and 25% growth happens, you have made your super normal return. So that's the kind of setup we constantly keep looking for, and that's when you see we have disproportionately large position in our portfolio.
Vikas, what's the outlook on the entire metal space in terms of which stocks or which kind of stocks you like? Because the latest views seem to be that China reopening is going to be a key driver for that space.
So frankly speaking, we don't have too much handle on it, and we keep hearing from experts that China opening up will drive the demand for that. When we did a little bit recently channel checks, more from a sensing that what inflation impact it can have on inflation. We are seeing China importing a lot of steel from India. So it could be, while we don't have a strong view because China is a complete, sort of a black box in terms of how long they will do, what context they will do, how it will play out. So we have no idea on that. So I mean, we have not, we don't have any exposure on the commodity space. Only reason we are watching it out is that if it sort of goes up, it have impact on India inflation. So both energy price and commodity prices will have impact on the India inflation, and that's the sort of input we are looking from both these indicators.
Yeah, it is a black box, isn't it? But Vikas, glad that you could take time out and join in today, and wish you a very happy new year.
Thank you, and wish you and your viewers a great year ahead.
Thank you so much. Good to chat with you as always.